Picture this. You're 29 years old, you have a decent job. You make about $55,000 a year. You're not rich, but you're not desperate either. And one night, after paying rent, you open your banking app just to check. The number staring back at you is $847. Not because you went on vacation, not because something broke. Just regular life, groceries, gas, subscriptions, the occasional dinner out. You do the math in your head and realize at this rate, you will never own a home. You will probably never retire comfortably. The game feels rigged before you even get to the starting line, so you do what millions of people do in that exact moment. You close the app. You order delivery. You buy something you don't need, because if the math doesn't work, why suffer and miss out? Here's the thing though, that feeling, that very specific hopelessness isn't laziness, it isn't immaturity. It isn't a character flaw at all. It is a psychological virus. And once it infects you, it quietly destroys your wealth more efficiently than any debt, any job loss, or any financial mistake you have ever made. And nobody is talking about it. My name is Felix, and I make simple animated videos about money and personal finance. If that's the kind of content that interests you, consider subscribing. And if you stay until the end of this video, I promise you will never look at your own financial habits the same way again. We are going to cover exactly what this virus is, where it came from, how to know if you already have it, and the 3 specific steps that break it. Let's go. Here is the uncomfortable question I want you to sit with for the next few minutes. Why do millions of people know intellectually that they should be saving money and still don't do it? Not because they're stupid, not because they're irresponsible, because most of the people caught in this trap are actually thoughtful, self-aware people who understand the math. They know that investing a few $100s a month matters. They know that $7,000 in credit card debt at 24% interest is a problem. They know, and they still can't make themselves act. For decades, financial advisors blamed this on discipline, or laziness, or emotional immaturity. And that framing has always bothered me, because the data doesn't support it. The average American savings rate right now is 4.6% of income. In the 1970s, it was 11.7%. So we're saving less than half what previous generations saved, relative to income. Is this generation simply twice as lazy as the last one? The answer is obviously no. Something else is going on, and the numbers tell the real story. According to a 2025 Bank of America study, 55% of Gen Z doesn't have enough saved to cover 3 months of expenses. Nearly half of Gen Z, the generation that started investing earlier than any previous generation, averaging age 19, is not saving for retirement at all. And almost a third of young adults ages 18 to 29 told Northwestern Mutual's 2026 planning study that they are now turning to high-risk assets, crypto, prediction markets, sports betting as their primary wealth-building strategy. 80% of them said it directly. They believe this is their only realistic path to financial goals. That is not recklessness. That is desperation dressed up as a strategy, and it has a name. This is called financial nihilism. And I want to define it precisely, because a lot of people use this term loosely. Financial nihilism is not just, I'm bad with money. Financial nihilism is a specific psychological state where a person has concluded, on some level, whether consciously or not, that the standard rules of wealth building no longer apply to them, that the gap between where they are and where they need to be is so enormous that normal progress is effectively zero, and therefore the rational response is to either do nothing or swing for the fences with something reckless. It is the brain saying, if I can't win the game, I might as well flip the table. And here's what makes it a virus rather than just a mindset. It spreads quietly, infects your daily decisions from the inside, and actually makes the financial situation worse, which then produces more evidence that the rules don't work, which deepens the nihilism, which destroys more wealth. It is a self-reinforcing loop that tightens every month you're in it. By the end of this video, you will understand exactly how the loop forms, exactly where it breaks down, and exactly the steps to get out of it. There's a mathematical reason this particular trap is so hard to escape, and I'm going to show it to you around the halfway point, so stay with me. But first, we need to understand where this came from, because financial nihilism didn't come from nowhere. Let's go back to 1967. A psychologist named Martin Seligman at the University of Pennsylvania was running a series of behavioral experiments, and what he discovered changed how we understand human motivation entirely. In his experiments, Seligman placed subjects into environments where they received negative outcomes repeatedly, no matter what they did. Every attempt to change the outcome failed. And here is what happened. After enough failed attempts, the subjects stopped trying. Even when Seligman later changed the environment so that escape was now possible, most of them just sat there and accepted the pain. He called this phenomenon learned helplessness, and I want to make sure the definition lands because it is critical for understanding what's happening to your money right now. Learned helplessness is not giving up because you are weak. It is giving up because your brain has run a cost-benefit calculation and concluded, based on real past evidence, that effort produces no results. The brain isn't being irrational. It has genuinely learned the wrong lesson. Now here is where it gets personal. Because what does the financial environment look like for someone who is 28 years old right now? The median existing home price in the U.S. is $414,900. The median household income is roughly $83,000. In 1985, the ratio of home prices to household income was approximately 3.5 to 1. Today, it is over 7 to 1. Home prices since 1985 have grown over 415%. Incomes have grown 255%. That's not a gap. That's a chasm. So imagine being 27. You look at a starter home in your city. It costs $450,000. Your gross salary is $58,000. You would need a down payment of $90,000 just to get in the door a mortgage that would consume 46% of your take-home pay before you've bought a single grocery. You do that math, you absorb what it means. And then you think, okay, at my current savings rate, how long does it take to save $90,000? If you're saving the national average, 4.6% of a $58,000 salary, that's about $2,668 per year. To save $90,000 at that rate, assuming nothing else goes wrong, would take you 33 years. You would be 60 before you could afford a down payment on a house that you were looking at when you were 27. That math is not discouraging. That math is devastating. And Seligman would tell you exactly what your brain does next. It stops associating effort with results, because the evidence says they are disconnected. This is not a personality flaw. This is your brain working correctly based on the data it has received. But, and this is the critical turn, the brain is working correctly with the wrong data set. And that distinction is the entire game. I'll explain exactly what I mean in a few minutes. But first, let's talk about what financial nihilism actually costs you in real dollar terms, because the number is going to make you uncomfortable. Okay, let's meet someone. We'll call him Marcus. Marcus is 26 years old, lives alone, and earns $52,000 a year before taxes. By the time taxes and Social Security come out, Marcus takes home about $3,400 a month. Now let's watch what happens to Marcus's money. Rent in his city for a one-bedroom apartment, $1,350 a month. That leaves him $2,050. Car payment and insurance, $680 a month, down to $1,370. Phone, internet, subscriptions, streaming. A few apps, a gym membership he uses twice a month. Because, honestly, motivation comes and goes. About $290 a month. Down to $1,080. Groceries and household basics, $380 a month. Down to $700. Gas and transportation costs, $180 a month. Down to $520. Student loan minimum payment, $220 a month. Down to $300. $300 remaining. And we haven't touched co-pays, clothing, car maintenance, emergencies, birthdays, haircuts, or the occasional thing that just happens, life. So Marcus is effectively at zero every month, sometimes a little behind, and he knows this. He tracks his spending, he's not clueless. And one evening, he sits down and does the math on what it would take to retire at 65 with enough to live on. He looks it up. To replace a modest $40,000 a year in retirement income at a standard drawdown rate, he would need roughly $1 million in invested assets by retirement age. Marcus is 26. He has $3,200 saved. To reach $1 million from $3,200, investing at a historically average market return of 8% per year, Marcus would need to invest approximately $350 a month for the next 39 years and never miss a single payment. He doesn't have $350 a month spare. He barely has $300 left, and that's before his roof, meaning his car makes an unexpected noise on the highway. So here is what his brain says. The math doesn't work. The gap is too big. Why delay every pleasure today for a number that is essentially impossible? Why not at least enjoy the now? And so Marcus spends the $300, month after month after month. And the gap between where he is and where he needs to be grows by compound interest, working in reverse against him. But here's the part that most finance videos miss. What does Marcus do with that feeling over the next 12 months? He gets the notification that his company offers a 401k with a 3% employer match. He scrolls past it. Because his brain has already concluded the game is lost. He gets an email about a high-yield savings account offering 5.2% annually. He doesn't click, because what's the point? He sees a coworker start putting away $100 a month into index funds. He thinks, good for her, but my situation is different. Because the learned helplessness has now built a specific belief. Normal financial moves don't apply to my circumstances. And this is where the real financial destruction happens. Not in the $300 Marcus spent on takeout and video games. Not in the impulsive purchase. Not even in the 24% interest credit card balance he's slowly accumulating. The destruction happens in the opportunities Marcus ignored. The money he left on the table without even reaching for it. Let me show you exactly what I mean with real math. Marcus's company offers a 3% employer match on his 401k. His salary is $52,000. 3% of $52,000 is $1,560 per year. That's free money. Marcus's contribution to unlock it would cost him $130 per month. About $4.30 a day. Less than a fancy coffee. But he doesn't sign up. His brain has told him the math doesn't work. Here is what that decision actually cost him in lifetime dollar terms. $1,560 per year, his contribution plus the employer match combined, invested at 8% annual return from age 26 to age 65. That is $3,900 total per year going into the account. After 39 years at 8% compound growth, that is approximately $1.1 million. Marcus walked away from $1 million, not because he couldn't afford it, because the financial nihilism virus told him the effort wasn't worth it. But it gets worse. Because while Marcus is ignoring that $130 a month, he's paying interest on $7,900 in credit card debt, which is actually below the average American household credit card balance of $11,149 at 22% interest. That's roughly $144 per month in pure interest charges, interest that builds nothing, interest that produces nothing, interest that is the mortgage payment on a house he doesn't own. And I want you to pause on that for a second, because this is the most brutal irony in the whole story. Marcus feels like he can't afford $130 a month to invest. But he is spending $144 a month on interest charges. He's paying more to service his paralysis than it would cost him to begin building a future. That's not a lifestyle problem. That's the financial nihilism virus at work, making choices on his behalf while he's convinced he's just being realistic. Now let me add one more layer, because I said I haven't gotten to the worst part yet. $200 a month invested at 8% average annual return over 30 years grows to approximately $244,000, $200 a month, the cost of 3 or 4 restaurant meals depending on where you live. $600 a month over the same 30 years grows to roughly $732,000. And if Marcus spent those 30 years instead paying $600 a month, minimum on revolving debt that he never fully paid off, he would have approximately nothing. Less than nothing, actually, because the interest would have eaten more than the principal. The mathematical doom loop. That's what I call it. Isn't that the math doesn't work? It's that the financial nihilism makes you choose the math that guarantees it won't. You skip the thing that builds the future. You keep the thing that destroys it. And then the bank balance confirms your fear every single month, which deepens the infection, which causes you to skip more opportunities, which makes the balance look worse. This is the loop. And here's the critical insight. The loop has an escape hatch, but it's not the one you're expecting. You might be thinking, okay, I just need to earn more. If my income was higher, the math would work and I'd feel motivated again. This is the single most common objection I hear, and the data destroys it completely. A 2025 Bank of America study found that 29% of Gen Z who are not saving say they simply don't earn enough. Reasonable, right? But here's the problem. Among Gen Z individuals who earn over $75,000 a year, a solid, above average income, only 18% were consistently saving a set percentage of their paycheck every month. Read that again. Even at $75,000, 82% were not consistently saving. Financial nihilism doesn't go away when income goes up. Because it was never about income. It's about the relationship between your present actions and your belief that they produce future results. Once that belief is broken, raises, bonuses, and side income all get absorbed by lifestyle inflation, which produces exactly the same mathematical paralysis at a higher price point. You end up exactly where Marcus is, just with a nicer car and a bigger credit card balance. Now, you might also be thinking, that's interesting, but my situation really is genuinely different. The market feels uncertain. Inflation is out of control, and jumping into the market right now feels risky. And I want to be fair. Those concerns are not insane. Here's the thing, though. That reasoning is the SEMTM, not the cause. Every generation has had a reason to believe the market was too risky right now. In 1987, the Dow dropped 22% in a single day, the largest one-day crash in history. In 2003, the market had just survived the dot-com bubble. In 2009, the financial crisis felt like the system was actually collapsing. In 2020, a global pandemic froze the economy in weeks. In every single one of those moments, the people who said the timing is bad and did nothing missed spectacular recoveries. The financial nihilism virus is incredibly good at disguising itself as rational analysis. That's what makes it dangerous. It doesn't feel like giving up. It feels like being smart enough to see that the game is rigged. But here's what the numbers show. Time in the market beats timing the market. Every single time. According to historical data, missing just the 20 best trading days of the last 30 years would have cut your investment returns in half. The 20 best days often come immediately after the 20 worst. The person waiting for a better time to invest is, mathematically, almost always worse off than the person who started imperfectly. But none of that logic works until you address the core virus. The infected part isn't the analysis. The infected part is the belief that your actions connect to outcomes. So let me tell you about the cure. And it has nothing to do with budgeting apps, side hustles, or motivational posters. The cure is about reconnecting one action to one result at a time until the brain builds new evidence. This is where we get practical. Here is what financial nihilism's recovery actually looks like in order. Step 1. Find the employer match and claim it this week. Not next quarter. Not after you figure out the rest of your finances. This week. If your employer offers any match, even 2%, and you are not capturing it, you are earning a guaranteed 100% return on that portion of your money. That is not a metaphor. When you put in $100 and the company puts in $100 and the company puts in $100, that is a 100% return before the market even opens on Monday morning. If someone offered you a guaranteed 100% return on anything else, you would consider it too good to be true. This one is actually real, legally required, and available right now. For someone earning $50,000, capturing a 3% employer match means $1,500 per year in free money. Over 30 years at 8%, that is $188,000 in wealth, not counting your own contribution, just the match money growing. Claiming the match is the gateway drug out of financial nihilism because it produces an immediate, measurable result. You do the thing, you see the result. The brain starts to rebuild the connection between action and outcome. That is the crack in the doom loop. Step 2. Kill one debt completely, not the biggest one. Not the most logical one, according to the math. Kill the smallest one. Whatever you owe $400 or $600 or $800 on that credit card with the embarrassing low balance you've been ignoring, attack it and eliminate it in the next 60 days. This is called the debt snowball method, pioneered by financial author Dave Ramsey, and it has been studied in behavioral economics research for decades. A study published by Northwestern University found that what most predicts debt payoff success isn't strategy. It isn't interest rate optimization. It's early wins. People who knocked out small balances first were significantly more likely to pay off their debt entirely, even if the mathematical optimal approach would have been to attack the highest interest rate first. Why? Because the brain doesn't run on mathematics, it runs on dopamine. And an early win, a zero balance on a card you've been carrying for 2 years, floods the brain with a signal that effort produces results. Frederick, your debt is controllable. You defeated one. Move to the next. This is how you reprogram learned helplessness. Not with spreadsheets. With evidence, small, undeniable evidence that your actions change your outcomes. Step 3. Set up one automatic transfer this month. Even if it's $50 a month, into a high-yield savings account paying 4.8 or 5%. Set it to come out the day after payday before you see it in checking. Here's what this does that's psychologically crucial. Automation destroys financial nihilism's greatest weapon. See, the virus lives in the gap between intention and action. It thrives in the moment where you plan to save what's left over, and then you reach the end of the month and there's nothing left over. That moment, repeated 12 times a year, is what teaches your brain that saving is impossible for you specifically. When you automate the transfer, you remove that moment entirely. The money moves before the decision point occurs. The bank balance you see every day shows the post-saving balance, which becomes your new normal. You adapt. You don't need to save $500 a month right now. You need to save $50 a month automatically for 90 days, so that your brain accumulates 90 consecutive days of evidence that you are a person who saves money. Because right now, the virus has convinced you that you're not that person. And that belief, more than any interest rate, more than any market condition, is what is bankrupting your future. Here's what that actually looks like over time, even at just $50 a month. $50 a month at 8% average annual return over 35 years is approximately $105,000. That's with no increase, no extra contributions, and no drama. Just $50 a month, automated, left alone. Increase that to $200 a month when you get a raise, and that's $244,000. Bump it to $500 when you're more comfortable. That's $871,000 over 30 years. The math always works. The only thing that ever prevented it from working was the version of you that believed it didn't. Here's what this actually feels like day to day. Because I know the advice can sound clean in a video and then feel completely different at 11 p.m. on a Tuesday when your checking account says $180 and payday is 4 days away. It feels like making the automatic transfer and then watching the checking account number and feeling a low-grade panic you didn't have before you started. That's normal. That's withdrawal from financial nihilism, not failure. It feels like telling yourself that $50 is a joke, that it won't make a real difference, that you should just wait until you have more. That voice is the virus speaking. Name it. Don't obey it. It feels like watching a friend post about their crypto gains on social media and wondering if you're doing the wrong thing with your boring $50 automatic transfer. You're not. According to Vanguard data, over any 20-year period in market history, A diversified index fund has beaten actively speculative short-term trading strategies more than 90% of the time. The boring move is, statistically, the winning move. The person who feels boring and consistent is, financially, the one quietly winning. And here is the most important thing I want you to take from this video. The financial nihilism virus is not your fault. You didn't choose it. You built it from real evidence, from staring at real home prices and real savings rates and real interest bills and concluding, as a rational observer, that the math doesn't work. But the math doesn't not work. The math never stopped working. What broke was the belief. And beliefs can be rebuilt. One employer match, one zero balance card, one balance card, one $50 automated transfer. Not because $50 changes everything this month, because claiming $50 this month is how you build the version of yourself who invests $500 in 2 years and $2,000 in 10. The amount is not the point. The identity is the point. The wealthiest people alive didn't start by investing huge amounts. They started by being people who invest, and that identity is available to you. Right now. Today. For $50 and 15 minutes online. I want to come back to where we started. You're 29, the banking app shows $847, and the math seems impossible. I know that feeling doesn't disappear the moment you watch a video. I know that, but here's what I want you to sit with. The people who eventually escape the doom loop are not the ones who suddenly earned more money. They're not the ones who found a brilliant investment strategy. They are the ones who made one small move, often embarrassingly small, and then watched what happened. And what happens is this: their brain updated. One data point of evidence that action produces results is worth 1,000 motivational quotes. You do not need to fix your entire financial life this week. You need to break the loop in one place. Just one place. And the loop starts to unwind. The financial nihilism virus is real, it's widespread, it's actively spreading, and it is costing an entire generation of people hundreds of thousands of dollars in foregone wealth over their lifetimes. The good news is, it is not permanent. The brain is not wired for doom, it is wired for patterns. And you can change the pattern. One move. This week, not next quarter. This week. If you found this video useful, I genuinely appreciate a like. It makes a significant difference in helping this channel reach more people who need to hear exactly this. And if you want the next video in this series to land in your feed, you know what to do. I'll see you in the next one.